Most people believe becoming rich is about earning more money or finding the perfect investment, but the truth is often much simpler and harder to accept. Many people never become rich because of one repeated behavior. It's not a lack of opportunity, but a pattern of actions that quietly limits growth. As long as this pattern continues, financial progress stays slow and inconsistent. The behavior is constantly delaying investing. Many people say they will start later when they earn more, when markets are stable, or when they feel ready. This delay costs time, and time is the most valuable factor in building wealth. Every year of waiting reduces the power of compounding and limits future results. Another issue is spending instead of investing. When income increases, many people increase their lifestyle instead of their investments. This creates a cycle where money flows in and out without building long-term value. Without investing, income alone rarely leads to wealth. Chasing quick results is another major problem. Many people look for fast ways to get rich, jumping from one idea to another. This prevents them from staying consistent. Real wealth is built slowly, and constantly changing direction stops progress. Fear also plays a large role. Some people avoid investing because they are afraid of losing money. While caution is important, avoiding investing completely guarantees no growth. Inflation slowly reduces the value of money that is not invested. Another common behavior is inconsistency. Investing only when convenient or when feeling confident breaks the compounding process. Wealth requires regular and disciplined contributions over time. Another reason people never become rich is constantly switching strategies. They start one approach, then abandon it when results are not immediate. Each new idea feels promising, but without consistency, nothing has time to grow. This constant reset destroys progress and prevents compounding from ever taking effect. Wealth requires commitment to a plan over time, not endless experimentation. Many people also rely too much on motivation instead of discipline. Motivation comes and goes, but discipline creates consistent action. When investing depends on mood or confidence, contributions become irregular. This inconsistency slows growth and weakens long-term results. Discipline ensures progress continues even when motivation is low or markets feel uncertain. Another mistake is trying to time the market. Waiting for the perfect entry point often leads to doing nothing at all. Markets are unpredictable, and missing just a few strong growth periods can significantly reduce long-term returns. Staying consistently invested is far more effective than trying to predict short-term movements. Ignoring small amounts of money is another problem. Many people believe that investing only matters when large sums are involved. Because of this, they delay starting. In reality, small, consistent contributions can grow into significant wealth over time. What matters most is not the size, but the habit. Another behavior that prevents wealth is reacting emotionally to market changes. Fear during downturns and excitement during rallies lead to poor decisions. Investors who act on emotions often buy at high prices and sell at low ones. Reversing the logic of successful investing, lifestyle inflation quietly blocks wealth accumulation. As income grows, spending increases as well. Instead of directing extra money toward investments, it is used for short-term comfort. This keeps people financially stuck, regardless of how much they earn. Another issue is lack of clear financial goals. Without a specific target, investing feels meaningless. This leads to inconsistent behavior and poor decisions. Clear goals provide direction and make it easier to stay committed over time. Many people underestimate the power of compounding. They expect fast results and become discouraged when growth appears slow. Compounding takes time to accelerate, and those who quit early never experience its full effect. Another mistake is ignoring diversification. Putting all money into one asset increases risk. A single failure can erase years of progress. Diversification protects investments and supports steady long-term growth. Avoiding risk completely can also prevent wealth. Keeping money in low-return assets may feel safe, but it limits growth. Balanced risk is necessary to achieve meaningful returns over time. Not reinvesting profits slows progress. Dividends and gains should be returned to investments. Without reinvestment, growth becomes limited and less effective. Comparing yourself to others leads to poor decisions. Seeing others succeed quickly can create pressure to take unnecessary risks. Staying focused on your own strategy is essential for long-term success. Another behavior that keeps people from becoming rich is ignoring long-term thinking. Many focus only on immediate results and judge success too quickly. When investments do not perform instantly, they abandon them. Wealth is built over years, not weeks. Without a long-term perspective, it is impossible to stay consistent long enough for compounding to work. Another mistake is not having a clear plan. Without structure, investing becomes random. Decisions are based on emotions or external opinions rather than strategy. A clear plan defines how much to invest, where to invest, and how to stay consistent over time. Many people underestimate the importance of starting early. They believe they can catch up later by investing more. However, time is more valuable than amount. Starting early allows compounding to work longer, creating significantly better results. Another problem is focusing too much on income instead of investing. While earning more helps, wealth is created by how money is used. Without investing, income alone rarely leads to long-term financial growth. Emotional reactions to news also prevent wealth. Constant exposure to headlines creates fear and urgency. Investors who react to every update make poor decisions and lose focus on their strategy. Another issue is frequent trading. Many believe activity equals progress. In reality, frequent buying and selling increases costs and leads to poor timing decisions, reducing overall returns. High fees quietly reduce wealth. Even small percentages taken annually can significantly impact long-term results. Lower costs allow more money to remain invested and grow. Another mistake is ignoring risk management. Taking too much risk can lead to large losses, while too little risk prevents growth. Balance is essential for steady progress. Stopping investments during downturns is a major problem. Lower prices often create better opportunities, but fear causes many investors to stop or withdraw money. Another behavior is relying on luck. Instead of discipline, some hope for a single successful investment to change everything. Sustainable wealth requires consistent action, not chance. Not increasing investments over time slows growth. As income rises, contributions should rise as well. Keeping investments the same limits long-term potential. Finally, lack of patience prevents success. Many quit before seeing real results. Staying consistent over time is what allows wealth to grow significantly. Another critical mistake is not automating your investments. When investing depends on memory, mood, or timing, it becomes inconsistent. Some months are skipped, others are delayed. Automation removes this problem completely. Regular automatic contributions ensure your strategy continues without interruption, building consistency and allowing compounding to work without relying on discipline alone. Many people waste unexpected income instead of investing it. Bonuses, gifts, or extra earnings are often spent immediately on short-term desires. However, these moments are powerful opportunities to accelerate wealth. Investing unexpected income can significantly increase long-term results, strengthening compounding and building momentum that would otherwise be lost. Another hidden issue is lack of long-term planning. Without a clear vision of the future, financial decisions become reactive instead of strategic. Investors drift from one idea to another, never building a stable foundation. Long-term planning creates direction, making it easier to stay consistent and align actions with meaningful goals. Constantly changing strategies prevents real progress. Every time you switch your approach, you reset your results. Compounding requires stability. Investors who keep jumping between ideas never allow any strategy to mature. Consistency in approach is what transforms small efforts into large outcomes over time. Focusing too much on short-term results creates unnecessary stress and poor decisions. Daily market movements are unpredictable and often irrelevant to long-term growth. Reacting to them leads to impulsive changes that reduce returns. Successful investors focus on long-term progress, not daily fluctuations. Lack of discipline is one of the biggest reasons people never become rich. Even the best strategy fails without consistent execution. Discipline ensures that investing continues regardless of emotions, distractions, or market conditions. It turns intention into action and action into results. Not understanding compounding limits financial potential. Many investors underestimate how powerful reinvested returns can become over time. Compounding starts slowly, but accelerates dramatically. Those who remain consistent benefit the most, while those who quit early never experience its full effect. Ignoring small habits reduces long-term success. Small decisions saving a little more. Investing regularly seem insignificant at first, but repeated over time, they create powerful results. These habits form the foundation of wealth and ignoring them leads to missed opportunities. Seeking shortcuts often leads to risky behavior. Quick gains are attractive, but they usually come with higher risk and instability. Sustainable wealth is built through steady, disciplined investing. Shortcuts often result in losses that delay progress instead of accelerating it. Quitting too early is one of the most common reasons people fail. Investing takes time, and early stages often feel slow. Many give up before results become visible. Persistence is what allows compounding to take effect and transform small investments into significant wealth. Not adapting gradually can create instability. While consistency is essential, small adjustments help maintain balance as life changes. Ignoring changes in income, goals, or risk tolerance can reduce effectiveness. Smart investors adjust slowly without abandoning their core strategy. Expecting fast results leads to disappointment. Wealth building is a long-term process. Those who expect immediate success often become frustrated and quit. Understanding the timeline of investing helps maintain patience and commitment. Comparing yourself to others creates unnecessary pressure. Every investor has a different path, timeline, and strategy. Trying to match others often leads to risky decisions and inconsistency. Staying focused on your own plan produces better long-term results. Fear of making mistakes prevents action. Some people avoid investing entirely because they want certainty. This hesitation costs time and opportunity. Taking informed action is better than waiting indefinitely for perfect conditions. Overreacting to market changes leads to poor decisions. Markets naturally rise and fall. Investors to react to every movement disrupt their strategy. Staying calm and consistent protects long-term growth. Not increasing investments as income grows limits potential. As earnings rise, contributions should also rise. This accelerates compounding and strengthens financial progress over time. The real difference between rich and poor investors is behavior. Discipline, patience, and consistency create wealth. Emotional reactions and inconsistency destroy it. The actions repeated daily determine long-term outcomes. If you keep doing these things, delaying, reacting emotionally, and staying inconsistent, you will never become rich. But once you change these habits, everything shifts. Your money begins to grow, and over time, those small changes create massive financial results.